Hello, I'm Juliet Sarli. In this week's edition of IG Macro Intelligence, we take a look at some of the best and worst performing ASX stocks over the 2025 financial year. The 2024-25 financial year was a solid one for investors, with the S&P ASX 200 notching up a near 10% return. That was its best year since full year 2021, when Australia was emerging from the depths of the COVID-19 pandemic. Financial, telco and infotech stocks saw the biggest gains, while geopolitical tensions, which roiled the oil market, saw the energy sector underperform, down more than 13% in the 12 months to June 30.
If you had not watched the news or paid any attention to the financial gossip columns and woke up this morning, you would have thought it's not a bad start to the year, considering what we delivered in 2024, calendar year 2024. So I think all markets are now in the black, as they say it. And look, that's a pretty comprehensive outline of what year-to-date returns are by asset class. Even Australian investors up 7.3%. That's not bad. Global stocks, S&P 500 is back to in positive territory. I think it's at an all-time high. NASDAQ up to 2.38%. So look, I think I said this a couple of months ago, and I said that, look, at the end of the day, you will see the markets and investors swipe right on a lot of these.
Not being invested in the country's biggest bank and largest ASX stock by market cap, the Commonwealth Bank, proved to be a mistake. CBA shares rose more than 45% in the financial year, despite analysts' calls that the stock is overvalued. Shares hit an all-time high of $192 in late June. ASX TradeWatch data suggesting the bullish momentum for CBA could continue. However, analysts have called time on CBA's run, with the average broker recommendation a sell, according to Refinitiv, with a target price around $117, suggesting CBA at current levels is around 37% overvalued.
It's absurd. I would call the pricing of CBA absurd at $190. It's 30 times earnings, it's 4 times book. It's a bank, people. It's not a growth stock. It's not going to grow its earnings more than 4 or 5% a year. Do not buy this stock.
Safe haven buying, which partially helped propel CBA, also propelled gold stocks in full year 25, along with the price of the physical commodity. Shares in gold miner Evolution Mining were up almost 130% in the 12 months to June. But analysts are cautious about its longer-term outlook, with most suggesting investors trim or sell their holdings. The e-commerce retailer Temple & Webster, another stock which rose more than 100% over the past 12 months, analysts on the whole remain confident it can continue its recent run, with the average broker recommending you buy the stock with a median price target of $19.55. The rate-cutting cycle and stronger consumer confidence is expected to work in Temple & Webster's favour. Well, shares in IDP Education came near the bottom of the class in full year 25. The stock has been hit by policy headwinds across all its major markets, including visa restrictions, processing delays, and tighter immigration policies. Yet, given its recent sell-down, the stock could rally a further 68% to its average price target of $6.18, according to Refinitiv data.
Big risk for IDP, which we identified years ago, and I don't think was rocket science if you looked at the country, what it did, is of course that this was entirely leveraged to 2 things. Number one, the universities continuing to use them. Any one of those major universities pulling a contract and revenue growth is not coming. And then secondly, international student numbers continuing to grow. And I think, COVID should have been a wake-up call if you hadn't seen that already.
Well, shares in Mineral Resources fell more than 60% over the past 12 months. Macquarie, which recently had an outperform rating on the stock, has now turned bearish on MinRes, cutting its iron ore and lithium forecasts. It has a neutral rating and $22 price target on the stock, largely in line with where it finished the financial year. And healthcare heavyweight CSL ended the financial year down almost 20%. Ongoing tariff uncertainty has hit the company, which receives around half its revenue from the US market. US government drug policy and proposed cuts to Medicare also sent investors pressing the sell button. However, many analysts think the future is brighter for CSL, the average target price at $313, suggesting it could rally 30% from here. The S&P ASX 200 is kickstarting the new financial year just over 1% from its all-time high. Meanwhile, Wall Street bulls drove stocks in the US to all-time highs at the end of June. The S&P 500 index up 25% from April lows, notching its best quarter since December 2023. Risks to the upside for stock momentum include the impact of Donald Trump's tariffs coming into effect from July 9, the American debt crisis, and geopolitical uncertainty. However, the expected rate-cutting cycle could prove fruitful for Aussie investors.
Of course, finally, that outlook for China, where we are seeing some of those capital projects really coming to the fore and being supportive to a more positive outlook. So I think all up, Jules, this August reporting season is going to be absolutely key for the Aussie share market, given that we are seeing relatively high historical valuations, and we do need to see that earnings growth coming through to justify those high valuations.
Still expect the index to grind higher towards the end of the year. I think the easy gains obviously have been had. We think the real correction comes midway, sometimes next year.
And that is your IG Macro Intelligence for this week. We'll see you next week.